Welcome back and on to corporate conversations. Then Kfin Technologies is the next management on our radar. It was a weak quarter, but to discuss this and more, Vivek Mathur, the Chief Financial Officer of the company, is joining in on the show. Now, Vivek, good afternoon. Thank you for joining in. You reported a 30% top line growth in FY25, a 44% roundabout margins in FY25. So what are the targets that you have set for FY26? Because FY25 was a very different year. Markets were good, at least for the first half, but you're going to a completely different, volatile, uncertain market for FY26. So what are the targets that you have set for the new year?
Thanks for hosting me, Hormaz. We believe that we will continue to grow at a pace of 18 to 20% on top line because we are a diversified company. We are not solely dependent on domestic mutual fund business. About 64% of our revenue comes from domestic mutual fund. And as you said, market was quite supportive in FY25. And we believe that, the support will continue in coming quarters as well. But having said that, the other businesses have been outgrowing the growth in, the domestic mutual fund business. If you look at alternates or, which has grown at 76%. If you look at international business, that will continue to grow at 25-30%. And, the new businesses that we are acquiring, which is the global fund administration business, up till now, the international business was just about 5-6% of our total revenue. We believe it will grow to 15% of total revenue in the coming year. And, we believe that margins will be in the range of 40 to 45%. And, whatever we are doing in terms of acquisition is all through internal accruals. We are a zero debt company, so there is no interest on the books. And we believe we'll continue to do well in terms of generating free cash flow out of EBITDA, which will help us in terms of not only improving the operating leverage, but also maintaining our guidance of 40 to 45%.
So you're maintaining margins of 40-45%, but on the top line, you're talking about 18 to 22%. And that's a marked slowdown compared to what you did. Is this a conservative guidance? And FY26, X of the acquisition on an organic basis should be similar to FY25. It's just that you're being conservative right now. Or are you worried about the domestic, mutual fund business, which is still 2/3 of your revenues?
So, Reema, it has always been our guidance that we will go at 18 to 20% top line growth, while the mark-to-market gains is something which has helped us in FY25. And that is something which we believe will be range bound as the retail investors continue to remain invested. And we see, our SIP market share is still healthy at 39%. So we believe that, it is not a conservative estimate, but a realistic estimate of what we have been maintaining quarter after quarter. Whatever flows into the mark-to-market gains and that flows into the bottom line, we reinvest that to create future moats or to invest in future products or future geographies. And that's how the guidance remains at 18 to 20%.
But Vivek, even after this, your domestic mutual fund business, you mentioned that you are a diversified company. Yes, but still a majority of your business, almost 2/3 of it still comes from the domestic mutual fund business, right? And a lot of these asset management companies in their earnings call have mentioned that their SIP book has started to flatten off. Considering the market volatility, it might start to taper down further as well if the markets turn awry. So what does that do to your domestic business and even as it still remains a core component of your top line?
So as I mentioned, 64% of our revenue is based on domestic mutual fund fee-based revenue. And if you look at within that, about 60% of revenue comes from equity AUM. So, if you can say about 40% of our revenue is dependent on how the market moves. So if there is a 10% reduction in the market movement, about 4% of the revenue will get impacted. So that is the, about 3.5 to 4% impact on revenue is the only impact that we will have. And other businesses like, issuer solutions, which is per folio per annum, and value-added services within mutual fund, which, almost 6% of the revenue, which comes from that. For the year gone past, overall VAS revenue has been 7%. If you look at alternate, that has been growing tremendously, about 70% plus. So, global fund services, which is based out of Southeast Asia, we have started winning large contracts. So, linked to market, the impact will not be huge. It will be range bound between 3.5 to 4%. And that's why our guidance that, we will continue to maintain good margins, a healthy yield, and top line growth, which will be in the range of 18 to 20%. We believe that domestic mutual fund should grow at a pace of about 14 to 15% organically without looking at mark-to-market abnormal gains. And that is what our guidance has always been, that if there are mark-to-market gains, our EBITDA margin will be in the upper range of 45%, and that you have seen in the last quarter. But for the M&A spend of 12 crores, it would have been 46%. But if the markets are not so good, we maintain a guidance of 40%.
Got that. What was the market share gain last year in the SIP business? It now stands at 39%, but did you gain market share?
No, we haven't gained market share. It is in the same range as it was.
Oh.
So we haven't lost market share, but we have been steady.
What about international business margins? While on the whole, you're looking to maintain your blended margins, your international business margins are lower than the rest.
Yeah.
The reason for that, or do you have levers to improve it, especially now that you've got an acquisition of Ascent?
It's more to do with scale. International business is not at a scale at which the Indian businesses are. Indian businesses are at a gross EBITDA margin of about 55-60%, while the international GFS business is in the range of about 30%. So we believe that as we started winning new contracts backed by platform sale through Hexagram, or winning TA and FA clients, as we get into leveraging Ascent, the margins and the scale will improve. If you look at absolute yield in that business, it's more than 5 bips, vis-a-vis 3.6 bips in the domestic mutual fund in India. So yields are healthy. It's a matter of getting scale, which we are now started winning clients. It takes anywhere between 18 to 24 months in the RTA business in Southeast Asia to win a client, because it is captive business to outsourcing. We don't have competition in Southeast Asia, unlike what we have in India. It's easy to win against competition than to convince client to outsource. And that's why it takes time. But once you get it, you get a ready-made AMC with ready-made AUM. While if you win a new client in India, it takes anywhere between 5 to 7 years to have a meaningful corpus and start getting better yields, which will contribute to the overall margin.
All right, Vivek, thank you so much for sparing time and joining us today. Wish you good luck for the rest of the year as well. The management there of Kfin Technologies, the stock doing well for itself, 2.5% higher at 1271. Take a short break. On the other side, Samiran Chakrabarti of Citi joins us to discuss the latest RBI open market purchase announced last evening. Stay tuned.
Hey, thank you for watching this on CNBC TV18. Hope you liked it. For more such interesting news and updates, follow CNBC TV18 on all the social media platforms.